Hello everyone, how are you? I hope all of you are doing good. So welcome to another session, and in this video what we are going to talk about is the financial management RTP of January 2026 attempt. So first we are going to take up the case study, which is a very easy one. Now in this specific RTP, some of the questions are directly from the module itself and some of the questions are easy, but they seem to be difficult. Why? Because they are a little bit twisted by the ICI. Rest everything is easy, not at all difficult, I'm telling you, right? The things are pretty easy. So let's start. Let's see the case study now. PPW Limited is a mid-sized manufacturing company producing the household appliances for the Indian market. With the competition heating up, the company's management is becoming increasingly cautious about the liquidity management and the efficient use of the working capital. During the last financial year, the company recorded the annual sales of rupees 48 lakhs, offering its customers a 3 months credit period. So what is this given to you? 3 months credit period that you are giving it to your debtors. So this is the value of D that is given to you. To encourage the bulk orders. While this has boosted the sales, it has also tied up the significant fund in the debtors. Obviously, sir, if you are giving the larger period to the debtors, D is large, so that means more of your funds are blocked. On the production side, the company incurs the following annual cost. Material consumed rupees 12 lakh, suppliers allow 2 months credit. Now this is what? Please be very careful here. Please do not take it as R. It is not R. R is what? The R is the raw material holding period. That is for how many days or how many months you are holding the raw material in the store. But this is the supplier's credit period. That means this is the value of C that is given to you. Next, wages 9,60,000 paid with a 1 month lag period. So lag period is given to you for the wages. Cash manufacturing expenses 12 lakh rupees settled 1 month in the areas. Again a lag period of 1 month for the cash manufacturing expenses. Administrative expenses 3,60,000 paid with a 1 month lag period. Again fine. And the sales promotion expenses 1,20,000 paid monthly in advance to the agencies. That means this is the advance period, monthly in advance. Right, so it will be treated as what? It will be treated as your prepaid expense, right? The company sells its product at a gross profit margin of 20%. It also maintains 2 months stock of raw material and 2 months stock of finished goods. That means your R is equal to 2 months, and the next thing is your F is also equal to 2 months. R means the raw material holding period. 2 months is the period for which the raw material lies in your store, is there in your store, not yet being issued to the production. F means finished goods are ready, but they are lying in the godown, not yet sold. Okay, next. Further, the depreciation is considered a part of the cost of production, but since it does not require a cash outflow, the management wants to ignore it while assessing the cash cost basis of working capital. That means the working capital is to be calculated on what? Cash cost basis. See, the very first thing is, from the information that is given, you will get to know that it is a question on estimation of working capital. First and the foremost requirement is, when you get a question, the first thing that you have to see is whether this question, the question is on which topic, right? Once you are able to identify the topic, half the job is done there. The minimum cash balance of 1 lakh is always retained for the contingencies. Now the board of directors has asked the finance team the following 5 questions. What will be the gross working capital of the company on cash cost basis? What is gross working capital? That means it is the total of current assets. Total of current assets is your gross working capital. PPW wants to compute its working capital requirement on the cash cost basis, assuming 15% margin. Based on the financial data, what will be the working capital? That means the total working capital statement, right? Let's prepare this much first. Let's prepare the statement of estimation of working capital, right? Okay, let's do it. Solution. Statement of estimation of working capital. The first thing that we take is, under the current asset, the first thing that we take is inventory, and under inventory the first we are going to take is the raw material inventory. Now the raw material cost is given to you. That is 12 lakh rupees material consumed, and what is the R? R is 2 months. So on 12 lakh for 2 months we can calculate. So 12 lakh multiplied by 2 by 12. So that will come to 2 lakh. Is there any WIP value that is given to you in the question? Read the question very carefully. Is there any WIP that is given to you? Any WIP given? No, sir. So that means directly we are going to take the second thing in the inventory that we are going to take is finished goods. What will be the value of the finished goods now? The value of finished goods is whatever is the total cost incurred on the making of the finished goods. What is the total cost incurred? Material cost is incurred. Yes, sir. 12 lakh we are going to take. Wages are incurred. Yes, 9,60,000 wages incurred. Yes, sir. We are going to take. Cash manufacturing expenses. Yes, 12 lakh we are going to take. What about the administrative expenses of 3,60,000? Now the question is silent that whether the administrative expenses are related to production or whether the administrative expenses are journal admin expenses. The question is silent. So we are going to assume it that these are journal admin expenses. Right, so the journal admin expenses will not be considered for FG. So for the calculation of FG, what we are going to take is we are going to take the material cost, we are going to take the wages, and we are going to take the cash manufacturing expenses. So total will be 12 lakh plus 9,60,000 plus 12 lakh. That comes to 33,60,000 that we are going to take. And what is the value of F? F value is given as 2 months. That is the finished goods holding period, right? So we'll take here 33,60,000 multiplied by 2 by 12, right? So this value will come to 5,60,000, sir. Correct. Now, we have taken inventory. In inventory, we have taken raw material. WIP is not given in the question. We have taken the finished goods. Next, what we are going to take is the value of the debtors. Now, for debtors, what we take? For debtors, we take the total cost of sales. For debtors, what we take is the cost of sales. So let's see what will be the cost of sales. This is the cost of goods sold that we have taken. In this, we are going to add the administrative expenses and the sales promotion expenses, right? So in 33,60,000, we are going to add the administrative expenses of 3,60,000 plus 1,20,000. That comes to 38,40,000. That will be the cost of sales. 38,40,000. And what is your debtors collection period? It is given that you are giving a 3 months. This value of D, 3 months to the debtors. So your amount is invested for 3 months. So 3 by 12. So that will come to into 3 divided by 12. That comes to, sir, 9,60,000. What else is there? Cash balance. Is there any cash balance which is given to you? Yes, sir. He says that the company wants to maintain a specific cash balance. And the cash balance, where it is given, the cash balance is given somewhere. It is given, sir. Yes, a minimum cash balance of 1 lakh rupees is always retained for contingencies. So this is your 1 lakh rupees as cash balance that we have to keep. Anything else to be taken in the current assets value? Yes, sir. One more thing that we have to take. What is that one more thing? That is the advance sales promotion expenses. Good point. So sales expenses which are paid in advance, that is your prepaid expenditure, and it is paid 1 month in advance, 1,20,000 and 1 month in advance, right? So that comes to 10,000 rupees. That's it from the current asset side. So the total of this total will give you what? Gross working capital. 2 lakh plus 5,60,000 plus 9,60,000 plus 1,10,000. So that comes to 18,30,000. This is your gross working capital. And first MCQ will be solved with this. What is the gross working capital he is asking? So the gross working capital is option C, 18,30,000 rupees, right? Now, let's come to the liability side also now to calculate the working capital. On the liability side, what you will subtract here is the creditors for raw material. Now, when we talk about creditors for raw material, I've already explained what is the thing that you have to see. You have to see whether it is a new firm or whether it is an old firm. In the question, nothing is mentioned whether it is a new firm. So that means we are assuming it is going to be an old firm. So in the old firm, whatever is the raw material consumed, that will be your purchases, right? So 12 lakh purchases, what is the credit period allowed by the suppliers? That is 2 months, right? So here we will take 12 lakh rupees as the credit purchases because nothing is mentioned, it is a new firm. So we are assuming that it is an old firm itself, right? Is that clear, sir? So 12 lakh, 2 months is the period allowed. So 1 lakh rupees is the creditors for raw material, minus what you will do, subtract anything else that will be subtracted. Yes, sir. Wages. Wages, what is given regarding the wages? That wages 9,60,000 is paid 1 month in the lag, right? 9,60,000. So 9,60,000 multiplied by 1 by 12. So 9,60,000 divided by 12, that comes to 80,000 rupees that we are going to subtract. After that, cash manufacturing expenses, are we going to subtract that? Yes, sir, because cash manufacturing expenses are also paid in the lag. 1 month lag period, cash manufacturing expenses 12 lakh settled 1 month in the arrears. Again, arrears means the lag period. So 12 lakh, again a lag period for it. So 12 lakh, 1 month lag period multiplied by 1 by 12, that is 1 lakh rupees again to be subtracted here. Sorry, here it is going to be 2 lakh rupees. Sorry, creditors for raw material will be 2 lakh, not 1 lakh. After that, admin expenses. Yes, sir, admin expenses also we have to take. Admin expenses of how much? 3,60,000. Yes, 3,60,000 paid again 1 month in the lag period. Admin expenses 3,60,000 into 1 by 12. So that comes to 30,000 rupees. Anything else to be taken? No, sir. Sir, sales promotion expenses, that is a prepaid expenditure that we have already considered. Now from here, what you will get is, from here you will get your net working capital before margin. Net working capital before margin, 18,30,000 minus 2 lakh minus 80,000 minus 30,000, that comes to wait, is there anything which is left? Is there anything I'm missing out? Maybe wrong calculation. Minus 2 lakh minus 80,000 minus 1 lakh minus 30,000, that comes to 14,20,000, sir. This is correct. Add safety margin. How much is the safety margin that the question says? 15%. Safety margin at the rate of 15%. So that comes to 2,13,000. This will give you the total working capital requirement that they are asking for. That is 16,33,000. This is your total working capital requirement. So MCQ 2, that what is the total requirement of working capital? That comes to 16,33,000. That is option A. Is that clear, everyone? Right. Next, excluding the 15% margin, what is the current ratio of the PPW? What is current ratio? Current ratio is current assets divided by current liabilities. The total of current asset is how much? The total of current asset is 18,30,000. What is the total of this current liabilities? 2 lakh plus 80,000 plus 1 lakh plus 30,000, that comes to 4,10,000. So what will be the current ratio? Current ratio will be 18,30,000 divided by 4,10,000. 18,30,000 divided by 4,10,000. Oh, that comes to 4.46. Right. So it is current assets divided by current liabilities. Yes, 4.46 is to 1. So that means if you have 1 rupee of the current liability, you have 4.46 as the current assets available with you. Then what is the quick ratio of PPW Limited? Sir, quick ratio consists of what? Quick ratio is current assets minus inventory. Current assets minus inventory divided by current liabilities. Now current assets, if you leave the inventory part, this part you leave. So what is left? 9,60,000 plus 1,10,000. Quick assets. These are your quick assets. These are your quick asset, that is debtors plus cash plus prepaid expenses. Oh sir, prepaid expenses also not to be taken, sir. So this we are going to exclude 10,000 also. Wait. We are going to exclude, sir, prepaid expenses also not to be taken. Right, because what are the quick assets? Quick assets are current assets minus inventory minus prepaid expenses. So 10,000 also not to be taken. So it is 9,60,000 plus 1 lakh. Quick asset is 10,60,000 divided by current liabilities of 4,10,000. So this will give you the quick ratio. That will be 2.59. or 2.58. Let's see what the option is given. So accordingly we will see, sir. 2.59 is to 1. Option number C. Correct. Any doubts up till this point? Very easy case study, sir. Very easy. The basics on the estimation of working capital. Very basic case study on estimation of working capital, right? Now next, what is the working capital turnover ratio based on the cash cost of sales? Working capital turnover ratio tells us what? It is the sales divided by working capital, but here he says it should be on the basis of cash cost of sales. That is cost of sales divided by working capital. Right now, what is the cost of sales that you have? Cost of sale is the total cost incurred. This is your cost of sale. This is your cost of sale. And what is the working capital? Working capital, here you will take this one, that is without safety margin. Without safety margin, if you take working capital, so it will be cost of sale is 38,40,000. And the working capital here is 14,20,000. 14,20,000, that will come to 2.7 times. Option D. Right. So what is the working capital turnover ratio based on the cash cost of sales? Because 15% is the extra safety margin that we are keeping. Right. Is there any answer that we get with the safety margin also? Let's see. 16,33,000. 2.35. No, if you are going to take the total working capital including the safety margin, then the option is not there. Then also the nearest answer is 2.7 only. Right. So they have calculated with the net working capital without safety margin for this particular purpose. I hope the case study is absolutely clear. This is the estimation of working capital, and the main important point here is WIP was missing, sir. That makes the question very easy. It was not a new firm. That makes the question very easy. Right. So this is the complete solution for the case study of RTP January 26. Now let's see the 2-3 MCQs which they have given, sir. Let's see the MCQ number 2. Please consider the following data. Project A, NPV is given and the investment is given to you. Given that NPV is equal to present value minus investment. Investment means what? This means your cash outflows. Right. And NPV is what? NPV is sum of present value of cash inflows minus sum of present value of cash outflows. Right. This they have represented by PI. This is the definition they have given as PI, minus this they have written it as I. Next, and the PI is equal to PV divided by I. Right. PI is where PV is the present value of the future net cash inflows and I is the initial investment on the project. Right. Based on the data furnished above, which of the following statement is correct? Project A is recommended on the PI criteria. PI is what? Profitability index. Profitability index is what? The sum of present value of cash inflows divided by sum of present value of cash outflows. That is what the PI is. So we need to see based on the PI and based on the NPV. So what we are going to do is NPV is given to you. Is project B recommended on the basis of NPV? No, sir. Why? Because project C is having a higher NPV than project B. So this option is out of contention. NPV, project A is recommended. No sir, project A is also not recommended based on NPV, because project B and C are there which are having the higher NPV than the project A. So the project A is also not in the contention. Right, so project B is gone, option B is gone, option D is gone. What is left is PI. Now we need to calculate PI. For PI, what you need to calculate first is PI. First, for project A, what will be the PV? Sorry, this they have written it as PV. Okay, fine. So for project A, PV will be NPV plus I. That is 15 plus 60, 75. For project B, present value will be 20 plus 100, that is 120. And for project C, present value will be 25 plus 150, that is 175. Is that clear? Now you can calculate PI. For project A, PI is equal to 75 divided by the investment of 60. That comes to 1.25. For project B, it is 120 divided by the initial investment of 100. So that comes to 1.20. And for project C, it is 175 divided by 150. That is present value of cash inflows divided by 1.16. So project A we can go with. So that means it is the option A which is correct. C is also not correct. Option A is correct. That PI criteria says, what is the PI criteria? That it should be more than 1. And the project with the highest PI tells us what? That if you are investing 60 rupees, what is the cash inflows you are generating? For every 1 rupee that you have invested, you are generating the cash inflows of 1.125. Here 1.20, 1.16. So the project which is giving the highest inflows, that will be selected, sir. Very simple. Is that correct? Right. So it is option A. Let's come to the third one. As per the extended DuPont analysis, return on equity is equal to NPM, that is the net profit margin multiplied by the total assets to total return multiplied by X by Y, where RO is return on equity, NPM is net profit margin, and the TATR is total asset turnover ratio. Correct. Here X by Y represents what? Very interesting. Very simple. And the DuPont analysis, as I have told in the lectures also, that they are asking in the MCQ, sir, whether they will give you the values. In September 2024 paper, they have already asked an MCQ on DuPont analysis, where the value, all the 3 values were given. You were to multiply those values and calculate it. So the answer is C. Total assets divided by equity, because that will give you what? That will give you the return on equity. Right, because DuPont analysis is what? It is the extension of the return on equity analysis. Next, fourth one, if the degree of financial leverage is given as 5 by 4, which of the following will be the interest coverage ratio? What do you mean by interest coverage ratio? Interest coverage ratio means the EBIT divided by interest, isn't it? EBIT divided by interest. Now what is given? The financial leverage is given. Isn't the financial leverage given to you? Yes sir, financial leverage tells us what? Financial leverage 5 by 4. That means EBIT divided by EBT. Financial leverage is what? EBIT divided by EBT is equal to 5 by 4. That means my EBIT is 5. My EBT is 4, yes or no? So what is the difference between the EBIT and EBT? The difference between this is interest. So interest is how much? 1 rupee. So what will be the interest coverage ratio? Interest coverage ratio will be 5 divided by 1 rupee. That is 5. Option A. Simple. Right? Financial leverage is what? EBIT divided by EBT. 5 by 4, that means EBIT is 5, EBT is 4. What is the difference between EBIT and EBT? That is interest, 1 rupee of interest. So interest coverage ratio, That is EBIT divided by interest. EBIT is 5, interest is 1, so that will come to be 5. Right? So with this we are done with the MCQs and the case study part of the RTP of January 2026 attempt. Right? In the next video we are going to take up the descriptive part. Please do share with all your friends this video. Thank you so much. Till then, see you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.